let's just talk about the moment we're in. At some point, you look around and realize the world has changed and you need to adjust your strategy accordingly, whether it's geographically or the business mix. You made that decision coming out of the last crisis. Does this crisis validate your response last time around, or do you need to make some changes again?
Well, firstly, Jonathan, thanks for having us on the show. Clearly, what we designed was a business that in times of severe stress would be fine. And when markets are very active and volatile, we would still perform very well across the whole investment banking franchise. This was that crisis, and that's what we delivered with a 15+% ROE. So I think it validates the strategy, but it's our strategy. It's not for everybody. This is what we chose. We didn't want to be credit heavy. We want to be flow-based, fee-based, asset-based, and that's what we are.
James, there's been a strong argument over the last week. We've heard from several CEOs of Wall Street institutions on this programme that we haven't fully realised the risks around this recession, that fiscal policy has made it more difficult to assess creditworthiness, and there's going to be more pain in the months ahead. James, would you characterise things a little bit differently?
Well, for the economy, it's very hard to tell. I mean, it depends on, how quickly the COVID outbreak that we're seeing across the South and Southwest subsides. How well people coming back to their place of work functions, continued liquidity and stability in the market. So it's too early to tell. But, we're not a credit-centric institution, so for us it's less relevant. But for the marketplace, until people get back to work, you're going to have consumer credit problems. There's no question about that.